host, Alec P. Tuckman, fiduciary financial advisor. He is the son of two award-winning economics professors. His brother is a day trader. His uncle, an entrepreneur. His grandfather ran a successful foundation. He's been learning how money makes money since he was in diapers. Today, you'll learn some of the most important financial information and wealth-building techniques available. And now, here's your host, Alec Tuckman.
Hello, listening audience. Welcome to the fantastic Financial Fundamental Show with Alec Tuckman, wealth advisor, and Eric Bram, killer comedian extraordinaire. We are demystifying finance one podcast at a time and having a darn jolly good time doing it in the process.
Yes, it's a jolly good time. Just listen to the sound of my voice. Is there anything jollier than that? I'm very funny. Ha, 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 ha.
You sound like my geometry teacher from 11th grade.
You were so grade. Sweet. Thank you, Alec.
Consider this the
That's
stuff.
what I was going for. So.
Yes, did it. Nailed it. Consider this the stuff they wanted to teach you in school, but just didn't know how to explain.
Did they really want to? It's just not in the syllabus. I'm sorry, it's not.
Oh, Eric?
And this is your geometry teacher talking, okay? And I know it's not in the syllabus because I wrote
Eric?
it. Yes, Alec.
Did you know there's not one, but two very different strategies to invest?
What? No, Alec, I did not know that there were two very different ways to invest. Someone failed to deliver that information to me when I was just a bit of a wee lass. No, but I didn't get the fax either, or the email, or any of that.
Well, you're just a ball of sass today, aren't you?
Sassy and crassy.
You're like Bizarro Eric, like Bizarro Superman. Remember that bad guy?
I know. I'm like totally hormonal today, except I'm not. I'm just in super sarcasm mode. Okay, I don't know what gives. I'm like out of control. I've had a Coke Zero, and I'm spelling my name with a K instead of a C. I'm crazy like that.
You're out of control. Say no more with the Coke Zero. I get it.
Yeah.
And the rest will be downhill from here. Slippery slope.
Okay, let's go back to what we were talking about. So there's two ways to invest, right?
Right.
Okay.
On a higher level, two different ways to invest.
And go ahead, they are what?
Investing for growth and investing for income.
Okay, so I'm a layman or a laywoman in a prior life that felt like you just said you can make money or you can make money. So it's like the same thing.
Well, yes and no.
Okay, so we're both on the weird side of the world today, okay? Okay, let me bite. Why yes, why no? Go.
So in both cases, your goal is to make money, but you're making money differently.
Okay, explain.
When we were younger, in our wee last days, in our 20s, our 30s, our 40s, oh wait, that's still now, wink wink, 50s.
I'm 50s, my friend, but it's the good old days. I remember those 20s and 30s and 40s. Wasn't that like last week?
When younger, we'll say, we should engage in a strategy called growth investing. Going for the growth, going for the G is what most people are doing in their 401ks, their traditional IRAs, their Roth IRAs, every day across America. They're essentially going for capital appreciation and doing a strategy called DCA.
Oh my gosh, these acronyms. Again, they're like, this whole business is acronyms. What is it? Dumb cow allowance? Is it dork come again? Or is it, I don't know. What else? Tell me.
So I gotta know, where on earth do you come up with these guesses?
I am just so creative. Oh, but let me say, down came Abby. How's that?
You were close. It's dollar cost averaging.
I was going to say that. Yet so far away. So far away.
So dollar cost averaging, DCA, is when you put the same amount of money into the stock market each month and you're investing for the long term, leveraging the market over decades in some cases. And even when the market goes down, you're still buying more shares, potentially buying on discount, right? You're buying more shares essentially at a lower price on some level, which overall may lower the cost of investment. That's a good thing. That's what people are doing, whether they realize it or not.
Yeah, it sounds like a good strategy. I approve. So everyone, I approve. Continue.
You approve this message?
Yes, I approve this message.
Dollar cost averaging is great. It's the way to go for growth. But because you're not drawing money from the accounts, the money made off the return, off the growth, and the dividends hopefully goes back into the investments themselves. You're reinvesting what you're making. That makes sense?
Yeah. Feeling adventurous in studios today. Please continue.
Yes.
I like this. I like this.
Good.
I'm getting this.
And ideally, you have compound interest to play. That's good. You have interest growing on top of interest. But do you know what dividends are?
I do. They're at the end of something. Dividend. Get it?
Boy.
Sorry,
Okay.
no, I don't know what they mean. It's
Okay.
something to do with math, I assume,
All
right?
Well, you're a better person for admitting you don't know, and I
Yeah.
appreciate that. But to keep it simple,
Okay.
imagine there are two different types of stock, right? This isn't always the case, but we're trying to simplify for the purpose of the conversation. But imagine common stock and preferred stock. Again, keeping things basic, right? There are exceptions to this rule, but if you have common stock, think Chipotle, right? When I got in back in the day, I got in at 1100. I keep my fingers and toes crossed and eyes crossed. It goes up to 1500, for example. When I cash out, I make a profit, right? That's the increase in the capital appreciation. As one of my clients once put it, it becomes real, quote unquote, when you cash out, as opposed to just being a paper loss or a paper gain if I don't cash out.
Okay, I'm with you. Somehow I can still get this.
Okay.
I'm getting this.
So at the height, I think it was at something like 1900 a share, something crazy, which is super nuts for a fast food restaurant that makes burritos. Insane. Anyway.
Hashtag burritos.
Then you have a stock like Apple.
Oh, like Fuji or Gala or Envy or Red, Green. Are there any others?
Washington Apple.
Washington Apples. I've heard of that little company before, I think.
Yeah, so Apple is a preferred stock. Imagine everything we discussed that applies, yes, to Apple, like Chipotle, but you have more.
Okay.
You know, on top of the capital appreciation, you have something called dividends, which are paid usually every quarter. And because as a stockholder, you are one of hundreds of thousands of owners in Apple, you effectively have a teeny tiny piece of that company.
I'm like the handle on one of their toilets.
You personally are like the handle?
I'm personally like the handle.
Or
People
you own
like
a handle
touching me
in
and
Apple.
yeah,
Okay.
and making me flush.
Okay. Well, even better. So ideally, you can make money again in two ways. So it's the capital appreciation of the stock and the dividends. People like dividends when they get older because it's one way to help replace income from your job. The more stock you own, the more you can potentially get paid on the dividend of the stock.
Okay, copy that, yeah.
Preferred stock also tends to bounce back faster after an economic disaster like the subprime meltdown in 2008. That's another reason people like it.
Yeah, that was not good.
Yeah. Another way, since you're a real estate guy, another way to look at it is if, for example, you have a rental property, which I know you do, and the capital appreciation, imagine that's the increase in the value of the actual home. Let's say it's a single family home. Let's say the value of that home goes up. That's the capital appreciation. But the rents are like the dividends.
Okay. So got it.
Does that help translate my financial ease for you today?
It does.
Okay. So when we look at growth stocks or value stocks, which have more growth potential, what you're doing essentially is beefing up the portfolio, which is really the goal when you're younger.
Got it. Hashtag beef.
Beefing is good. No vegetarians here.
Yeah.
So there comes a point when we have to switch strategies. It's a paradigm shift in your brain, right? We have to near retirement or go into retirement, and then we have to reallocate our assets.
Okay, well, then what happens?
So you're on the edge of your seat, aren't you?
I want to know this.
Yeah, so then we do something called reallocating, and we utilize different tools like bonds and bond-like instruments to sustain us and give us consistency in income rather than trying to, again, beef up those assets.
Okay, awesome. But tell me again, what's a bond? Besides 007, obviously. I know he's already awesome.
Right. A bond is simply a debt instrument, right? All you're doing is you're acting as the bank, loaning your money to a government or corporation. And for the honor of them, those entities borrowing your money, they pay you something called interest.
And we love interest.
We love interest. Yeah. So much, in fact, that people are willing to make significantly less in a bond instrument, for example, because they want to be in a safer instrument than, let's say, stock. That isn't necessarily the case these days with inflationary times, but you can still make more return potentially than you would putting your money in a bank account, for example.
Yeah, that's not really hard to do right now. I mean, you make zero from your bank account. Yeah.
0.0, right. But there
always has to be that but in there, Alec.
There's always that but.
Yeah.
Oh, why is there always that but? The challenge right now is if and when interest rates start ticking up even more, bond prices may get crushed yet again. because there's an inverse relationship between bond prices and interest rates. Whenever one is up, the other goes down. It's vice versa. It's like a seesaw.
A seesaw. Never in history has there been a more dangerous fixture on a playground. I mean, except for the merry-go-round. That merry-go-round that you ran on, you know what I'm talking about? And then you jump on.
Yeah, I think that, the merry-go-round I think was worse.
That's why they don't have them anymore. Okay, and I'm the reason. I'm the poster child for those merry-go-rounds. Right. That's a whole other podcast.
They were dangerous.
They were very dangerous. And seesaws are not easy either.
Right.
And diving boards. Hello. Okay.
Doesn't it matter on who's on the other end of the seesaw? You could go flying if it's a big
Fat
kid.
Ethel's on the other side. You're screwed. Okay. Anyway.
So
sorry, Fat Ethel.
When we look at income,
Fat Ethel.
We look at income investing, right? We're refocusing the assets so they're working for you. And rather than working on bulking up that portfolio, what we're doing is, our investors will make that pivot to an income portfolio and maybe get 4, 5, up to 7% return in some cases. And they'd be okay with that. They'll be okay because they're in a different stage of their lives. They may be, the kids are out of the house. They may have paid off the mortgage. The cars are paid off. They may be retired and they're living on other alternatives besides their job income, like Social Security or pensions, and they're settled and not going many places in life, not doing many things. So they're okay getting the 4 to, let's say, 7% return off of their investments and having less risk in their portfolio. And when you look at, let's say, a $500,000 portfolio, maybe they get, that $25,000 off the dividends and interest that they're able to live on and still preserve the principal. And they're okay knowing they're living on that income and preserving the principal because they still have either an emergency fund or they can still have a legacy for their heirs.
Did you just hear that click, Alec? Did you hear that click?
A click?
Yeah, that was the light bulb that just went off over my head.
But is it eco-friendly? That's what I want.
Always! How dare you? Of course. Save the planet. #Earth.
So the income coupled with, let's say, Social Security, the rental income, like I said, maybe that person in retirement has a pension or maybe they have the annuity to accentuate the income. Maybe they have money for their kids or grandkids when they pass, and maybe they lead a frugal lifestyle. By making that switch to the income strategy, they may not have to worry about going through their savings and their retirement accounts.
That sounds very sad because that's what I've been doing lately.
Going through your assets?
Yeah.
But you're not in retirement, and you can still make it work.
That's true.
The strategy is for retirees, right? They have time on a high level, what they're doing, ideally, through the investor's life cycle, right? The way we invest when we're 20, 30, 40, again, different than 60, 70, 80, or 90. What we're doing when we're younger, we build up our assets and resources, and we want to reallocate later on to, again, produce the income. And the long-term goal is to sustain yourself through a 20, 30, God help us, 40-year period where you never have to have that conversation of run out of money.
Got it. So if I'm listening to you correctly, growth investing is when you try to grow the assets, and income investing is when you try to take money out, but you're living on the money that your initial bigger chunk of money makes you.
Precisely.
See, this finance thing isn't just for Alec Tuckman. It's not as hard as everyone says it is.
Do keep in mind, I try to keep this very simple for the sake of our listeners.
Okay, fine. Fair enough. So what are some of these income strategy assets you're talking about?
So we mentioned a few already, right? We have bonds and bond-like instruments, which are everything from federal government bonds to local and state bonds, known as municipal bonds or munis. Then you have corporate bonds, which tend to be more riskier, and they usually pay out better because you are taking on more risk. There's that expression, with risk comes reward, right? So because you're taking on that more risk, they want to compensate you for the added risk. We also have things like bond ETFs.
Oh, I know that is. Eric, 2, fun, Saturday.
You and those acronyms, man, it kills me. Don't even bother. Look, okay, I'll save you the work. It's exchange-traded funds.
What? I was close.
What they're doing is they're taking bonds and repackaging them to be bought and sold 10, 20 times a day. They have low to no transactional fees. There are actually ETFs with stocks and bonds. But in this case, what we're talking about with different income-bearing assets, we're looking at, in some cases, bond ETFs. Then you have things like REITs, real estate investment trusts. We talked about them in another podcast earlier. to call yourself a REIT, you have to have 90% pass through of the profits. Whew, that's a mouthful. And we like REITs for that reason, right? It's a very profitable venture, right? Real estate's good. And you don't have to evict tenants. You don't have to repair leaky roofs. You don't have the 3 T's. You know what the 3 T's are?
Time, trains, tushies.
Nice. Tushies, really?
I'm sorry. You asked me what they were. I know what they are.
Tenants, termites, and I forget the last one, but
so it could have been tushies.
It could have been tushies, right? But you have to deal with all those nonsense things you have to deal with hard assets, right? You have to evict tenants. You have to deal with the leaky roofs. You have to mow the lawn, right? All that stuff you don't deal with a REIT. It's very advantageous for that reason.
And I don't want to be in an income strategy until I'm in retirement.
So like I said, in your 20s or your 50s, you want to go for growth. You want to bulk them up as much as you can. You can take the risk. You can ride the stock market roller coaster and never have to worry, right? Well, I'm sure some people worry when we go down like 2008, but it rebounds over time, right? Let me just stop here and say, look, there's a big difference between losing your money and having the assets temporarily go down. And that's something I think we definitely need to differentiate, because I get that a lot when people come in here. I hear, I don't want to lose my money. And I tell them right out the bat, look, there's a big difference, right? There's losing your money where you're going to play that carnival ride or throwing the darts in the carnival or the ball games, at the fairs you have. Right. And then you lose your money that way versus when you're looking at investing in a stock, which Apple may be up one day and down the next.
So growth. So you want growth.
Growth is good. Yeah, growth is good, but there may be a point in your life when you have to reallocate, nearing retirement or in retirement or after retirement. And there's something called, and this is a big deal, because in 2008, when you have a devastating portfolio event, like what they call a black swan event, like a black swan event's 2008, right? It's like COVID, something that doesn't come along very often, but it's a devastating event. There's something called the sequence of returns.
That sounds like an ice skating competition.
Hardly.
Yeah. No, but a black swan.
Where do you come up with these things?
I'm sorry, because I'm brilliant. But black swan sounds really bad. No one wants a black swan.
Right. Well, the black swan, this is not the one you see running across a golf course. But when you look at sequence of returns, what you're looking for, if you're looking at the difference of a negative event happens right before or right after you retire. If you have that devastating event in the first 5 to 10 years before and the 5 to 10 years after, that's going to affect your portfolio significantly more than if it happened down the line.
Okay, so what do you mean by that exactly? I mean, I know what you mean. I know what you mean. But some of our listeners who are not as brilliant or good looking as myself, they may not understand what you mean.
Sure, it's always the listeners that can't keep up. Right? So when we
it's me.
Like we talked about before, we want to reallocate for retirement, right? So we want to reallocate and invest differently because when we're young, we have the time. But now we have a finite amount of time that we need to sustain ourselves and not go through our life savings. Let's look at 2008 for that example. If you retired a year or two before the subprime meltdown or a few years after, you didn't have enough time to accrue assets the same way that you would if you had retired in, let's say, 2003. The stock market hit a decline of 55% at the bottom of a market. That was the low point. It took a year and a half to bottom out. Think about that.
I'm still trying to wrap my head around it.
So mathematically speaking, the first decade you enter into retirement is absolutely crucial to protect your assets and be able to sustain your portfolio for the rest of your life.
Why?
So if you look at an example, let's say you're taking out 4 or 5% of your retirement accounts to survive. Then suddenly, bam, the market drops to half. Now you're still taking out 4 or 5% on half of what you were. You could increase your withdrawals, but then you cannibalize your portfolio faster. That's bad.
Yes, cannibal, bad. Cannibal, bad, bad cannibal.
Right. And the first question is...
Sorry.
That's okay. You roll with it.
Yeah.
The first question is, how can you survive on half the amount of money that you were once living on?
You can. It's hard. I see how that's going to suck.
You're eating through a bigger percentage of your portfolio because you're taking the same amount off of less. Does that make sense?
Yes. Okay. Yeah, it does.
So then the next question is, how much will that limit the potential of your success in retirement, knowing you're pulling money and the market is down?
that big uh-oh moment, that you get is just hit me, and I'm now enlightened, but I am very, very sad.
Yeah. Unfortunately, too little too late for a lot of people I speak with, and it's unfortunate. So back to how to sustain yourself in a worst case scenario like this, and that's what we're excellent at doing. We have 2 or 3 different types of software we leverage to be able to give you probability in terms of your strategy and how well you're going to do based on the way you're investing, which I love. Also, we can go as in-depth as you want to. We can get knee-deep in it. So understand the market has been roaring, or was roaring, the last 12 years, really since the bottom, which is 2009, with a couple of speed bumps here and there. And really understand that's not normal, right? Eventually, the market correct. And
covering ears, la 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 la, listening, not listening, not listening.
So we already know.
La 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 la.
So are you done?
I'm done.
Okay.
Sorry.
So as we know, it's already corrected. We've had a slide this year. Question is how much longer we can slide. Now, it's true what goes up may come down. So you want to be prepared and anticipate that.
Yeah, but I can't even anticipate what I'm going to have for dinner tonight, much less anticipate a market drop. That is unless Alec buys me dinner, which I will accept.
And yes, that's on the agenda for today. But getting back on track here, understand that when you talk to a financial professional, that's why it's important, right? You want to get someone else's opinion besides your own. I talk to way too many do-it-yourselfers who just don't know what they're doing. And while they're like, oh, I'll put my money in an index fund, I'll stay the course, and that's it for life. Like I said, the way we're investing as a younger person is very different than the way we invest in retirement. And a lot of people just don't understand that. On another note, before I move on.
That was a very pregnant pause there, Alec.
Right. Well, I was just thinking, right? Okay. I was just thinking, here's the challenge.
Click, 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 click.
I had a particular case pop in mind of this one woman that, she came to me. She was a divorcee. She said she has alimony. And she said she was fine. She's actually a lawyer that didn't practice law. She was living on a great divorce settlement. And the good news is she had a good settlement. The bad news is she was spending something like $300,000 to $400,000 a year on jet setting around the world. And the first thing that happened...
Do you have her phone number?
She's a tad old for you, but I don't know, maybe we can make it work.
Okay, good.
But the challenge is when she came in, after I sat down, I started using a calculator and did the quick math. She said, well, you're probably going to tell me I'm going to go through my assets pretty quick. I'm not going to have enough for retirement. And really, I looked at her, I said, really, that depends on you. Because if you keep spending the way you're spending, income is the outcome. Without income, you're just a homeless person on the street. And at the rate that you're spending, you have the assets. But the way you spend, Michael Jackson spent less money than you did when he was alive. And what worries me, he ended up in bankruptcy. So just watching the way you spend has me very concerned. And I said, I can't predict the future, but if you keep going as you're going now, you're in for a big shocker. And you have the alimony, which could run out potentially, or what have you if your husband passes, right? The challenge is, I want you, when you go out to eat, I would rather you be able to not worry about ordering the steak or the salad when you're with your friends, right? I want you to be able to have that choice, not forced to do the salad because you have to financially.
That makes sense.
And I sit here and we talk about theoretical situations here, but and maybe I should share some more stories. I mean, I go through this every day. I've anywhere from 3 to 5 meetings a day, and I can tell you some of them are not fun meetings. I hear a lot of horror stories. One scenario where, for example, I had a wife come to me in tears where her husband gambled away their 401k money. I mean, that was not a fun conversation. The good news is there was a happy ending. We found alternative scenarios where we could do a reverse mortgage, for example. We talked about ways she could still start investing now and start generating income. She did go back to work. But I hear these stories every day, and my goal in doing this podcast is really to make sure that people don't replicate these mistakes.
Well, it's awesome that you're on our side, Alec, because I might need you in the near future.
Good to hear. And shameless plug there, but I appreciate it. And jokingly, someone once called me the Mother Teresa of the financial realm, because I do help everyone that knocks on our door in some way, shape, or form. They may not be a great client fit, but I do want to help everybody that we come in contact with.
And Mother Teresa was a lot better looking than you are, Alec.
And I have a lot less lepers than she did.
That's right.
As a collection, but
I'm the one.
I digress. Here we go.
Okay.
So that's our time for today, guys. It's been a pleasure. And again, what we want to do is help you with anything financial related. The question I want to leave everyone with is, will you be able to apply some of the things that we've talked about today?
Yes, I'm giving you all my money, Alec, because you sound like you know what you're doing, and I don't want to not have the steak or the salad. I want to have the steak and the salad.
Very good.
That's my goal.
Unfortunately, $3 is a little below our minimum requirement.
Sizzler, here I come.
I'll still take care of you. I'll take care of you. All right. Well, if you need anything with anything financial related, not you, Eric, but our listening audience, anything from financial or retirement planning to tax strategy, estate planning, risk management, investing, generating income retirement to not outlive your income in your retirement years, mitigating risk and investing in the market, you give us a call. If we can't help you, we probably can connect you with someone that can.
Hey, I heard on the street that you're very good at connecting people with other people.
The rumors are true. You're correct, sir.
I knew it.
That we are. So, guys, don't forget to click, subscribe, like us, review us, LinkedIn us, Facebook us, tweet us, YouTube us.
LinkedIn us?
What's the verb there? I'm not even sure. And subscribe to our podcast and share it with friends and family if you like it. Reach us at our office, 844-242-0073. Check out our website at wmplainc.com or email us at info@wmplainc.com. Until next time, make it a great day, everyone, and stay safe out there. And
happy investing!
Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator for future results. Strategies mentioned may not be suitable for everyone, and opinions expressed do not take into account your particular situation or objectives. Before acting on any recommendations mentioned, please seek the advice of a qualified tax professional or investment advisor to determine whether it's appropriate for your specific situation. Or investment advisor to determine whether it's appropriate for your specific situation.